Well, it is true that the Portuguese investment management sector has not recovered from the crisis and that the assets under management have not reached the values before the crisis. I think that there are a number of reasons for that situation, some of them coming from the supply side and the others from investor side. From the supply side, let's say the Portuguese system is very much based on banks. So investment management is already an important sector, but we have this history, this tradition of the financial system being grounded on the banks. From the supply side, they traditionally privilege the supply, the offer of banking products instead of investment products. But we have a very specific situation in Portugal. Not only we had the crisis like all other countries in Europe, but we had specific problems like the resolution of a number of banks, which had investment management firms in their remit or groups. And what happened with these resolution cases was that deposits were protected, but investment products were bailed in. And as they were bailed in, investors lost their money. They were not protected against resolution measures, and that created a huge misconfidence, mistrust of investors in the market and in investment products. We have not been able to recover investors' confidence and trust since then. They still look at investment products with mistrust, and sometimes because we also lack a little bit of financial literacy, they have not yet understood that investment products in a context where the deposits are not paying appropriate interest rates, investment products could be an alternative, but this is something that the Portuguese investors, not generally, but some of them, have not understood yet. So what are we doing to address these issues? Well, I'm a regulator, so the regulator is not supposed to provide market development measures, but at least we as regulators, we are trying not to be a problem for the market. And not being a problem means first simplifying, and simplification is the word for us. So we accepted the challenge of simplifying legislation, regulation, procedures, authorization processes, and slowly moving towards a ex-post supervisory model instead an ex-ante supervisory model, which makes it easier for investors and easier for market players to accede to the market and to the products, of course, having to expect from us a tough, rigorous, severe and attentive supervision action after the products have been marketed or distributed. But there are some responsibilities for the asset management sector as well. It is not for the regulator to solve this problem. For sure, it is mostly for the asset management sector to deal with it. And this involves, from my perspective, that asset managers and the asset management sector becomes aware of the reasons why the market is not progressing better than it is. They should be able and have the courage of making the question, why is it not working? And prepare, conceive and implement the appropriate answers. And the answers, in my view, are costs. And when I say costs, it's reducing costs, but most of all, making them comparable and transparent. The answer means addressing conflicts of interests and overcoming them. The answer means putting in place appropriate corporate governance structures at asset managers level. The answer means fitness and propriety. Make sure to investors that top leaders, top management are fit and proper people who are able and credible and reputable to assume the fiduciary duty of taking care of the money of other people. In a word, they have to be able to convince investors that they are not playing with the money of other people. In addition to this, I think that diversification is also a responsibility for the asset management sector. They should actually take very seriously the opportunity that they are facing with this low interest rate context where deposits mean no remuneration, and they should take this opportunity to provide investors in the market with real alternatives which would offer them secure, safe instruments, but at the same time satisfactory returns. And this is the mix of these measures, I think, would end up in something different at the Portuguese market, but also at the European level. Well, I think ESMA did and is doing a great progress along these last years, but most recently, ESMA is focusing on supervisory convergence, having it as its main priority as a central goal, which determined, among other things, a different structure, a different governance, and a different internal organization to prepare the grounds and the structures to allow for effective supervisory convergence. And I think that the ESMA is doing very well. We have a new organization, as I was telling you, in putting in place a different structure. According to the new ESAS regulation, the management board is now in charge of supervisory convergence peer review. So it has been put at the top management level of the organization, the highest level. There will be peer reviews committees, but even before this new structure is in place, there are signs of clear progress, not only from a structural and organizational point of view, but also from the point of view of the results. And I can tell you about a few examples. For instance, we had on the last 2 years, I would say, a supervisory convergence network which dealt with more than 200 cases of relocation under Brexit. And all the cases were addressed, analyzed, discussed among the members, the NCA members, which make part of this supervisory convergence network. And it worked very well because it ensured that member states did not take advantage of this future Brexit situation to adopt a race to the bottom approach, or to take advantage of the situation to attract firms to their markets by lowering the requirements. This is one example, a new structure that was prepared specifically for this purpose, but that in the future it may serve as a pilot, as a sample for new structures or new examples of how at ESMA level we can deal with the most relevant supervisory convergence cases, like Brexit, like intervention powers, intervention measures, or others that may arise. But it is something so important for ESMA currently that we have it as a central objective or goal or priority, but then it is split among the organization, and it's like incorporated by all the standing committees, which are now starting or have been starting on the last 2 years, I would say, to discuss concrete supervision cases. For instance, in asset management, which is the issue, the more relevant issue here, I can tell you about liquidity, risk management, leverage, costs, MMF scope, and other things like these ones, where the NCAs discussed concrete cases and prepared guidance, Q&As, and so on the basis of concrete situations and concrete exchange of experiences. We also have, from a more institutional point of view, new tools. We are starting to work on so-called common supervisory actions, which are supervisory actions on specific issues that all the member states conduct at the same time or together, to be more precise, to make sure that all of us adopt the same approach, the same interpretation, the same views about concrete situations and concrete cases. There is a supervisory handbook being planned, where we will have supervisory cases described and the way they were solved, so that they can serve in the future as a sample or a benchmark for all the NCAs leading to similar cases. We will have the peer reviews committees, as I told you. So the progresses are there, the results are there, but of course there is still a long way to go. And I think that the main challenge is not the organization, it's not the structure, it's not the tools, which are there and they are appropriate. It's a cultural challenge, because member states have to decide and the NCAs have to decide if they really want supervisory convergence. And if this is the case, and I hope and I'm sure that this is the case, then we will progressively have to take a different cultural approach towards the dilemma of being part of a nation, part of a local market, but also part of the European supervisory system. Well, this is a false question, I'm sorry, if I may. I think that there's no opposition between regulations and directives. They serve different purposes. They should be adopted in different cases and regarding different material issues. For instance, but this is just an example, I think that the flexibility and proportionality that we can get from the directives is useful, for instance, when you are dealing with something new, with something about you as regulator or policymaker don't have all the answers or all the certainties. But it may also be that the concrete or the material issues that you are dealing with are so different, have so many specificities that at least in a first movement you have to try to respect these differences. This said, of course, the fragmentation of the markets is a problem, and we have to react to this fragmentation in all the ways, with all the tools that we have, and sometimes regulations instead of directives may help overcoming this fragmentation. But the reason why I was saying, this is my conviction, that having to choose between directives and regulations is a false question and a false dilemma, is that the key issue is not opting for directives or regulations, but have appropriate supervisory and enforcement powers and tools and practices in force, because they are complementary. And this is not because you have a regulation or a directive that you will ensure to have more convergence, more consistency, more horizontal practices. You have to have, first of all, appropriate supervision, rigorous convergence supervision and enforcement measures. And this is when you look to the alternative of keeping on having very detailed regulation, relying on extensive regulation, detailed regulation, very close regulation, or have a principles-based approach there. For this option to be a real option, to be a real alternative, you have to take the supervisory dimension on board, because I believe that you can progressively go to a more principles-based system if and when you have the appropriate supervisory powers and measures and tools and the appropriate and convergence enforcement tools. So when I say this, I'm calling for the market participants, market agents, to be also responsible for allowing and contributing for supervisory convergence, because they cannot see, and we saw that most of the people today were not very much concerned about supervisory convergence. They don't see, I believe, the importance of this reality. But then, if we think that probably most of them would prefer a more principles-based regulatory approach, they have to understand that this is only possible if we have in complement the right supervisory system and the right enforcement system, convergent one. Well, that's a difficult question because, starting with UCITS, it's easier. UCITS, the UCITS review, it's not a priority. It's not mapped as a priority for the next few times. So we are not, Europe is not planning in the next future a review of UCITS. And this is because this is a very resilient, long-lasting regulation piece, which has proved very well against the challenges and the background where it is applied. So we don't feel the need for a UCITS review on the next few times. The same doesn't happen with AIFMD. It's not a matter of feeling it as necessary. It is, as you know, planned since it's at its beginning, because it was a very complex, extensive, and very new piece of regulation. So it was decided that in a few years' time it should be subject to a review. On the basis of the KPMG report, the conclusion is that it has been proving to be working well. It has achieved its main objective, which was to foster a real market for AIFs and for AIFMs in Europe. So its main objective seems to be fulfilled. There is no problem, a huge problem or even a big problem with AIFMD, but there are certain issues which will merit being addressed. They are very well identified in the KPMG report, but we at ESMA, we have been, of course, interacting with stakeholders and trying to get from them their feelings about what should be and what shouldn't be subject to a review. And as a general approach, and there is a general understanding, I think, within the market and the regulators, that we won't need a wide, deep, essential review of the directive. I cannot take it for granted, but I suspect that we will have a targeted review, very targeted to specific issues like delegation, remuneration, conflicts of interest, depository, and third countries, maybe, which is something that is posing some questions to the market. But I don't expect, and I think we don't expect, a wide and deep review of AIFMD. Well, we have a few. I think that the first priority, the one that comes immediately to my mind, is to reinforce the prudential supervision of funds and fund managers. And this is so because we have a specific circumstance now. We, the securities regulator, we have been very recently allocated the responsibility for the whole prudential supervision of asset managers in Portugal, which was responsibility for the central bank. We had some responsibilities towards the funds and so on, but it was mainly a competence of the Portuguese central bank. There was a political decision, everybody agreed with that it should be centralized and put together in one authority. So the Portuguese Securities Commission will be in charge as of the 1st January 2020 of all the prudential supervision of fund managers. This triggered a movement or a project at the CMVM, at the Portuguese Securities Regulator, to review the regulation in order to make it fit, simple, appropriate, updated, and as flexible as possible to respond to the market needs and to the market requests, to have a clear framework, a simple framework, and so on. But this is not the only reason. We have been very attentive with regard to the prudential side of asset management. And when I say that, I'm thinking about liquidity issues, risk management, internal controls, corporate governance, fit and proper, capital required or own funds requirements of asset managers. This is something quite new in our supervisory approach, but this is something which is requiring from us also some adjustments of our supervision and progressively more attention given to these issues. Apart from that, we have MMFs, the money market funds. It's not that we have many market funds in Portugal. I don't think that we have, very few. But the problem is that there is not it seems not to be a consistent regulatory supervisory approach across Europe with regard to what is a money market fund or a fund which is similar to a money market fund. And this poses us a lot of problems because we have adopted a very restrictive or demanding approach towards this scope definition. But this is seems not to be the same at other countries, and this creates arbitrage between the markets, and we have been looking at it very attentively because we have the other funds acting in Portugal as if they weren't MMFs, and so creating a problem. These are the main, I would say the main domain, and also costs and performance fees. We believe that this is one of the reasons why investors are departing from the asset management sector. Is that again, and as I told you, it's about costs being too high, but also or mainly about costs not being transparent and comparable. And this is why we are looking very closely to this problem and trying to address it from a supervisory perspective.